Hello everyone, my name is Chairwoman and you're tuned in to The Next Wave by TechCabal. For our very first edition last week, we talked about the state of fintech in Africa, what that landscape looks like right now, and what the future holds. Today, for our second edition, we're talking about why exits matter and what it will take to produce more of them in Africa's startup ecosystem. In recent times, we've seen some really interesting acquisitions in the space, notable among which are Paystack's acquisition by Stripe in 2020 and Capricorn's acquisition by MFS Africa in 2021. We've also seen some important listings on local and public exchanges. For example, Jumia's listing on the New York Stock Exchange in 2019. It's important to note, however, that unlike mergers and acquisitions, IPOs have been few and far between. Part of our discussion today will be us looking into why that is and what it will take to generate even more successful exits in the African ecosystem, including IPOs. Discussing this with me today are Juliet Anammah, Chairwoman, Jumia Nigeria, and Group Chief Sustainability Officer, Yewande Senbore, Partner, Finance and Capital Markets Practice at Olaniwun Ajayi, Victor Basta, Founder and Managing Partner, DAI Magister. Thank you all for joining us today. I'd like to kick this conversation off with Victor. Before we even begin to talk about IPOs, it's important to point out that they're only one means to an end. The majority of successful African exits have been through mergers and acquisitions, as we've observed in the past few years. Now, my question is this: how can we create an ecosystem that allows for more of these deals to thrive in Africa's tech ecosystem?
So, first of all, it's important to know that of successful exits, 90% are through M&A rather than IPO. Only 10% are IPOs. They get a lot more of the press, but actually it's a very small number. And we're talking successful exits, companies that have scaled and are worth a few $100 million or $1 billion plus. So because 90% of successful exits are M&A, it's fundamental for companies, CEOs, and investors to be pointing their businesses towards potential M&A exit and to be doing the preparation that they need to do over the course of a year or two once the company's grown up enough. So one of the main things about creating an ecosystem that allows more deals to thrive is connectivity between African startups and large buyers who are, for the most part, not based in Africa. And that connectivity is actually pretty rare at the moment. There will be large companies in different sectors based in the US, Europe, or elsewhere that know very little about the most interesting African startups. If they knew more, if they knew the CEO, if they understood the model, if they understood how those companies could help them strategically to expand in Africa and maybe expand elsewhere, then those companies, large companies, would immediately, I think, be more interested in Africa expansion. But it's the ecosystem hasn't yet done a consistently good job of connecting with large potential buyers and promoting those businesses in the right way in front of buyers. And there's a reason for it. It's a young ecosystem. It's been focused on fundraising so far. But very soon we're going to graduate out of the fundraising only stage to, okay, now where's the real money? And the real money is when you sell a company for $1 billion in cash, not when you raise $50 or $75 million into the business. That's the real test of whether the company is a success.
Thank you so much, Victor. Very insightful thoughts there. Seeing how much more common acquisitions are compared to IPOs, is gunning for an IPO something that should become a norm for startups? In your own opinion, Victor, do you think they should just be focused on thriving, growing, and launching their successful products first?
So it's a very good idea to prepare for an IPO. And by that, I mean get the financial controls in place, compliance in place, board structure in place. So to start to look and feel and a little bit operate like a nearly public company. That's just even more of the growth, or rather grown-up phase of a business. And it's healthy for a business to have all of that rigor in place. But that's completely different than actually trying to do an IPO. As I said, 9 out of 10 successful exits are M&A, so it is few and far between. And if you're trying to do an IPO, literally you have no idea whether you will be successful until 11:59 the night before, because markets go up, they go down. There are plenty of companies who prepare for an IPO for 6 months, and then the market shifts on the day they meant to go public, and they stop. So it's not in your control whether you can go public or not. And so it's very healthy to start the process of preparing for it because it improves and strengthens the company. But the focus really should always be on strategic M&A and building those relationships with large companies and making the company attractive. So one way or another, the vast majority of successful tech companies are going to be involved in a large M&A deal of one form or another. So the earlier you prepare for it and the more work you do towards it and the more thoughtful you are about how to get maximum value, the more successful the company ultimately is. And that is the fundamental part, ultimate determinant of success. It matters, of course, if you raise $50 million or $100 million. I mean, that's incredible. But what really matters is somebody pays you $1 billion in cash. It can be a lot better for founders. For example, if you're a founder and you own 40% of your company, and that company is sold for $200 million, let's just say. Personally, I know it sounds incredible, but you get $80 million. Now, imagine you've gone through multiple funding rounds, and as a founder, you own 10 or 15% of the company, right? Not 40%, just because you've raised more money. Now, that company sells for, say, it doesn't sell for 200 million, it sells for 300, okay? It's still a lot of money, but you've only got $30 million out of the business. So oftentimes raising less money and building a company to a certain value because the founder keeps more of the company. He or she can end up with 2 or 3 or 4 times the amount of personal money by being careful about fundraising and thinking about exit. Now, we can all do the math. And of course, if you own 10% of a $10 billion company, then forget about it. But that doesn't happen very often. So my point is that sometimes raising less money and doing an M&A deal can be far more valuable for founders than just keep raising.
Now, exiting may not be the goal for every startup. And sometimes it's easy to get a bit carried away by news of successful deals that come in quite often. Should startups be focused on exiting at all? Or is it important to note that exits are not always the hallmark of a successful startup?
For the most part, companies raise money, build value, but maybe not as much as the founder hopes. But what's certain is that their percentage ownership definitely goes down. That's the guaranteed bit. What the company ends up being worth isn't clear, especially with market uncertainty. If you're going to raise $20 or $30 million and your equity stake, your ownership in the business is going to get cut, are you really confident that business is now going to be worth twice as much? Really? And so my point is it's worth founders thinking about the trade-off. Do I keep raising more money? Or do I think about a strategic M&A deal and what's the value of what I've built to me, my family, and everybody who depends on me? And very often it can be a lot more valuable to think about an M&A deal than a fundraise, which is, by the way, why in our Africa practice, of the large rounds that we have started working on since the beginning of the year, half of them involve M&A in some form or other. People are already thinking about this. It's just not visible yet in the market overall.
Thank you so much for sharing your thoughts with us, Victor. I do agree that while exits should sound exciting and they're great for startups, I believe that in the early stages, what should matter is launching a successful product, taking it from ground zero all the way to the top, and then perhaps having a conversation about exiting or considering an IPO. Now, I want to turn the conversation over to Juliet. In the past 10 years, we've had 2 startups get listed on foreign exchanges. Jumia listing on the New York Stock Exchange in 2019 and Mudondo listing on the Danish Stock Exchange in 2020. Since then, there hasn't been a public listing on a non-African exchange. On local exchanges, we've seen a few more examples, like Egypt's Fori listing on the Egyptian Stock Exchange and Nigeria's eTransact listing on the Nigerian Stock Exchange. However, these local listings are too far and too few in between. From your perspective, Julia, why do you think that is?
One thing is critical for a successful IPO, and I think timing is very important. Timing it's extremely important for many reasons. And if you look at, for example, the macro environment, that's a very important one. I can certainly speak about the current environment that we are right now. If we look at the war in Ukraine and how that is impacting global geopolitical tensions across board, you look at the prices of commodities and energy, and that's also resulting in decisions on inflation and how to rein in inflation by different central banks and so on. So it's not exactly a very auspicious timing for IPOs, I would say. And like I said earlier, that timing is extremely important. The macro environment has to be right. Of course, investors themselves have to be in a mood for investment. But back to where I started, ultimately it is a corporate decision, and most companies will think very carefully whether they want to go public or they still want to remain private. But ultimately, an IPO is a corporate decision to go public.
Thank you so much for sharing your thoughts with us, Juliet. It's important to note that timing is important and having everyone who is working in that corporate team be aligned as well. Now, as a company that has listed on a public exchange, can you share some learnings you've picked up along the way and some key tactics or things that other startups should keep in mind if they're looking to list, whether on a local exchange or on a public exchange?
Thanks. That's a great question. Yeah, I mean, the important thing is readiness, and readiness along multiple dimensions. Of course, if a company is going public, then of course it means changes in ownership and structure. It means increased transparency. It means organizational changes in multiple areas as well. Of course, we're assuming, of course, that the business model is already proven before the company is desiring to go public. But these are many aspects that a company takes time to ensure that they're ready for it. And there's a very important role that auditors, lawyers, bankers play in that whole preparation and readiness, preparation for a company before it goes public. Now, once a company is ready and has more or less done all the things it needs to do to be ready to go public, then again, like I said earlier, timing again is very important, because sometimes the market is more bullish in certain sectors than it is in other sectors. So you've got to know the timing. Is a market looking at the particular sector of your startup at that point in time? Then I mentioned also earlier about making sure also that the macro environment is the right one before you make the move.
Thank you so much, Juliet. So some key takeaways from that is, 1, startup has to be ready. 2, the timing has to be right. And 3, the environment has to be ready as well. Thank you so much for speaking with us, Juliet, and for coming on the show. We're going to go on a quick commercial break, and we're going to be right back. Welcome back from our break, and thank you for sticking with us. Now we're going to speak to Yewande. The Nigerian Stock Exchange is worth over 20 trillion naira. That's over $50 billion. Yet, as of 2021, out of the 170 companies listed on the NSE, only 3 of them were from the tech sector. About 5 more, MTN, Airtel, and a few others, are in the telco industry. So Nigeria's most valuable tech companies like InterSwitch, Paystack, and Kuda Bank are in a way shunning the NSE and going more after offshore funding. This signifies a problem. Now, I've said all these to ask, how can we boost the value of local exchanges?
The first point to note is to ask the question, currently, how do tech startups or other startups, how do they raise capital? Today, you find out that depending on the stage a startup is at, you would have them go through different forms of capital raises. So bootstrapping, friends and family, angel investors, and then when they get to, seed stage, venture capitalists who are willing to take the risk of an early stage project such as startups.
Yeah.
And when they come to maturity, private equity investors who have the appetite and the sophistication to fund such companies and also to take on such assets, then bring in money on a timeline, which is typically 5 to 10 years. Of course, you have developmental financial institutions who are also playing in the tech space, where you have tech companies that are aligned with their overall goals.
Yes, this is true.
So when you think about the spectrum and the model that tech startups and other startups typically follow, and you look at the way the capital market works, then you realize that it's not so much a case of shunning the capital market, but it's just about the business model that exists.
Yeah.
Where do this capital come from? So in real terms, very limited number of companies have huge valuations sitting on the Nigerian Stock Exchange. And what you find with startups generally is that their capital comes from offshore.
Yeah.
Most startups raise their capital from outside the continent. In 2021, about $4 billion was raised on the African continent across different countries, largely Kenya, South Africa, Nigeria, and Egypt, taking 81% of the chunk of the 4 billion plus that was raised. Nigeria took about a fifth of that capital. All of it, if not everything, actually, came from outside the shores of this country. Even the local investors who invested in those vehicles brought their money in from outside to get CCI.
Yeah.
So the key question should be, why are these startups looking outside? Because the capital market deals in Naira, the local currency. Why are they raising foreign capital? I think that in itself is at the heart of participation in the capital market in Nigeria. If you look at what the regulators have been doing to attract, startups, SMEs into the stock exchange, over the last decade, there have been a number of innovations and a lot of new regulations, rules being published just to encourage listing. All of these things are in place. You have the growth board of the Nigerian Exchange Limited. And even when you look at it, there are only 6 companies on that growth board. The requirement for listing on the growth board is not as extensive as what you find on the main board or the premium listing board. But we're still not getting that traction. So I think the key thing is, let's look at the way the startups are set up.
Yeah.
What is the goal really behind it? Does the goal align with that of the capital market? Because capital market is about working capital, ongoing capital. But it seems that startups are set up and structured for exit valuation purposes, which typically the capital market may not be able to fund. If you think about the crowdfunding rules, which is in place to aid early stage funding and capital raising, I'm not sure anyone has really taken advantage of that body of rules. So there have been activities, but I think the key issue is about the nature of startups. At least currently, the focus is not so much about dividend distribution, which is what typical investors on the stock exchange. Across the world, you're looking at continuing returns, of course, exit valuation at the end of the day and capital appreciation, but largely they're looking at ongoing returns in the form of dividends. But that's not what most startups are looking at. They're building up, the investors also, they're not necessarily looking at dividends. If you look at most of the companies, the startups, how many of them declare dividends? It's really about building the company to a stage where there is value that has accrued in the company that can then be exploited at exit. Now, the key question would then be whether an IPO is a valid exit option for a startup when it comes to that stage, in terms of the quantum of capital that they will be trying to raise, and whether the market, the Nigerian exchange, or any African market is sophisticated enough to absorb the kind of investment that they will be seeking to raise at that point in time.
It's interesting that you brought up the IPO angle, because we had spoken to Juliet about that earlier. and whether IPOs were sustainable or if they were, I mean, they're seen as dubious to many, but there are still startups who want that. They want to IPO, they want to exit. We saw the example with Paystack, how successful that was. I think it's also interesting that you mentioned the role that regulators are playing and the resources that appear to be available to startups, but for some reason, it seems like they're geared towards receiving funding from outside and even gunning for foreign exchanges as opposed to local exchanges. So thank you for that. Those are really insightful. My next question is around hindrances that startups or other kinds of companies face when it comes to local listings, right? Do you think that there are too many requirements, or are there larger issues at play that we can't see behind the scenes?
I think, to be honest, the requirements for listings globally are fairly standard. And on the African continent, it's not any different than what you would find on international exchanges. In fact, maybe some of the international exchanges have requirements that are more stringent than what you find on the local exchanges. And you still see that some startups end up on the international exchanges and they don't shy away from there. Of course, there is a need to make disclosures as an integral part of going public. For you to be listed, you have to be a public company, and there are disclosures that are required. That requires you to open your books to your investors and to the public. That, for me, is at the core of why a number of companies actually shy away from the capital market in terms of listing their securities on the exchanges. For startups, if you think about it, one of the core things that you will note is most startups are not necessarily properly structured. It is not peculiar to tech. It is just that for new companies, even SMEs, I mean, the growth board of the Nigerian exchange has been put in place to enable SMEs come on board and then tech companies and startups to come on board with less stringent rules than you would find for the main board or the premium board. But without proper structures from a corporate structure perspective, corporate governance policies in place, then there won't be a listing because these are prerequisites. Now, that being said, when you juxtapose the requirements for a PE firm to invest in a startup and the level of requirements and due diligence that is undertaken in order for that to take place and the time that it consumes, and you then run that aside, what it takes to list, you realize that you really cannot say that the requirements for listing on the exchanges are too stringent or too many. I think it's really just about preferences. As I mentioned, with the local exchanges, there is something that is still ongoing, which is literacy, continuing education of the investing public. That is at the heart of the growth and deepening of the capital market across Africa, particularly Nigeria. When you look at the liquidity that you find on the market, it's not enough to just list. I list because I want traction. I want activities. The investors want their shares to appreciate. But if there are no trades, then there won't be any appreciation. If there is no market for exits, why would you invest in a listed company? Because you might as well have invested in a private company because you can't get out. So it's about driving education, not only on the side of the investors, but also on the side of the founders, the startup founders, to educate them on the benefit of the capital market, approaching the capital market, but also how that helps, because it helps you to put structure, it helps to put governance in place. And so that also prepares them for an outward listing. You find companies that are dual listed on the stock exchange in Nigeria and also in other jurisdictions. Yewande several years ago was listed on the Johannesburg Stock Exchange as well as Nigeria. EcoBank is listed dually. You have Seplat dual listed. So this is possible for startups, but there are steps to get there. And those steps need to be taken. As I said, if you do not educate both the investor side and the stakeholders, the companies that are going to invest, to understand that there is a meeting point that is mutually beneficial, then whatever structures are being put in place will not work.
There's some really great points that you've raised. I think that what you said about education, educating both sides on the benefits, the challenges as well, knowing that this is what you're going to come into if you're thinking about doing XYZ. I think that's a really, really important point. So thank you so much, Yewande, for sharing your thoughts with us. We really appreciate you coming on. And thank you to all our speakers for talking to us about the importance of exits and IPOs. We understand that in the industry, it can be quite exciting to hear about companies that are exiting maybe after 3 years, 4 years, 5 years. But it's important to note that timing matters, corporate governance matters, and ensuring that the environment is ready for you to either exit or to IPO. It's been a super critical conversation, and I cannot thank our guests enough for joining us, and to you for watching us. As always, you can tweet at us using the hashtag TheNextWaveCNBC. You can also send in your feedback via email to thenextwave@techcabal.com. Next week, we'll be talking about Africa's most interesting topic, cryptocurrency. Join us same time next week. See you soon.